Good morning and good afternoon. So instead of making a market review, a daily review, so this will be a live review of price action. So we're targeting these highs and also these highs. So and price has already taken these highs on the weekly time frame. So let's check the daily time frame and get right into the price action for the. So I need to take a lot of things off real quick. All of the intraday markup from yesterday's trading will all be taken off while we trade today's trading. So we've already pierced buy stops here after taking out sell side liquidity. So let's check the 1 hour. So after we took out sell side liquidity, we had a rally higher. So this is the first stage. I'm interested in this imbalance. Let's see if we trade to this imbalance and then rally higher, or we just keep trading like this. Now, I'm expecting this to be a second stage delivery, a second stage reaccumulation of the distribution phase. So we have to see if this fair value gap here, this daily fair value gap, let's streamline it down to the 15 minutes here. So if this fair value gap here is acting as a support for price to take price higher, that means we'll go into the lower time frames looking for a fractal nature of the same pattern. First stage, after this consolidation, accumulation, manipulation to the downside, distribution, reaccumulation. The first stage, rebalance this imbalance, come back to it, go higher. Second stage, coming for these lows, trading inside of this imbalance and going higher up to buy side liquidity here. So we'll be using the ES as a barometer. We'll be using the Nasdaq as a barometer for this price action because we are solely trading one asset class, which is the US 500. So the ES, the Nasdaq will be used as a barometer only. And from narrative here, when when the ES fails to fill an imbalance like this for when there's a factor nature in price and because of the correlation between the ES and the Nasdaq, when the ES is unwilling to tap into its imbalance. That is price indicating higher prices for that asset. So you see this 1 hour BC. Let's streamline it to 15 minutes. Let's take this 1 hour off because the imbalance found on the 1 hour, this is it more precise here on the 15 minutes. So price is unwilling to come for these lows here. While on the Nasdaq, which is the US 100, we have price trade into its low here like this. So when you have this cracking correlation like this, you go into your lower time frames looking for a fractal nature of this price move. So let's pay attention and watch what's going on. So if we are to go for these highs here, this is the accumulation, the manipulation leg lower after 9:30. You see, at 9:30 equities open, price took out these highs and then came down for these lows. After taking out the lows, so I would not want to see these lows filled. Price is allowed to come for these lows short term, and I would want it to leave an order block or an imbalance after coming for these lows if it does come for these lows. But let's pay attention and see how the algorithm prints. So here you have a breaker block. This is a bullish breaker because you have this candle here and price rallied higher going into the right direction, but because of time is not aligned with price, this will be sell stop order resting below. There will be sell stop order resting below here, and the algorithm will use it to pair smart money buy entry. Then smart money will fill their position below these lows here, which is buying below old lows and then offloading above old highs. This makes the market an efficient price, an efficient market. So you see, we fail to come for these lows, meaning it's extremely one-sided. Let's see, but we need to see how it prints. So it's taking out buy stops with no retracement to this imbalance, which is fine, but we want to see how it gets here. If we get above the fourth, above the third quadrant of this liquidity pool, this fair value, I'm not interested in taking any longs again because we can easily reverse here because we are currently above the Sunday's opening price, currently above midnight, currently above 8:30. So the rule states that you buy above opening, sorry, you sell above openings and you buy below openings. So because we had London failing to come for midnight opening, failing to trade below midnight opening price. That is indicative of a one-sidedness in price. So here we have the first stage. First stage is here. Let's see what this is doing. So we already have price trade to the fair value of this liquidity pool and this buy stops here. So I am not interested in taking any position currently now because of narrative in price. So we have to observe the first 30 minutes of after 10 a.m. to see what price has to offer. If we are still interested in coming for these highs, no, or later in the afternoon session. When you have a high impact news like FOMC, the day after the current day you're trading, you expect you expect price action to seek both sides of the market to prevent early speculators that are trying to speculate on what the Fed are trying to do on doing FOMC's release. So that is the reason why we are currently being nimble while trading to today's trading, being Tuesdays, a day before FOMC. One thing you should understand is that having no trade placed is better than going against your rules, against your laid out rules and the current model you're using for a specific account. You can have different trading models, but to get a specific and measurable and something that you can measure to measure your accuracy and your strike rate, stuff like that, you would need to stick to one particular model and execute solely based on that model. And that model should include time because you'd want to you see if this market is indeed algorithm being run by an algorithm, it should run on time because the first theory of algorithmic principle is time. Every form of algorithm that is being coded in every aspect of science is first being coded by on the basis of time. So so we have the Nasdaq, which is the US 100, respecting its lows like this, and coming for these highs. Let's see. Because if this is the long-term low and this is long-term high, this should be the intermediate term high, sorry, an intermediate term low, and this right here will be an intermediate term high. And now, if this intermediate term low is violated, this is this is what I explained earlier about how you are to be nimble when trading the day before a news release like FOMC because the market makers will be compressing price into a range, trying to take out both buyers and sellers. Because if you, as a speculator, speculate before the release that price should go higher and you are correct, even if it goes higher during the release, the algorithm is designed in such a way that it will take you out before that release, even though your directional bias is correct. So we are not obsessed with the idea of being right, of being right. We are more obsessed in on the idea of precision, precision in all aspects, precision in your execution of your rules, or how you follow your rules to the T. Like there should be little to no ambiguity when following your rules. If your rule states that you are buying below this liquidity pool. That is what you're doing. If your rules state that you're not trading till 10 a.m., that is what you're doing. If your rules should be well written out, like you should have multiple sets of journals. One of your journals should have an in-depth explanation of your model, of your favorite model. It's like there's a analogy Michael used in one of his teaching. I think it's 2022 or 2023 mentorship. He talked about having a room, having multiple rooms, and your models are like multiple rooms. So Me personally, I don't sleep in just my bedroom. I have multiple rooms in my house currently. So there are times I would like to sleep in the living room, which is the parlor. There are times I would like to sleep in the bedroom. So as I was saying earlier, sorry about the cutoff. OBS stopped recording. So I've been having problem with my OBS. I think it's something I'll have to uninstall and then install back the OBS because it keeps crashing while I'm recording. And I didn't even know it has crashed before while I was still speaking. So back to the point being made earlier. When when you are now interested in the idea of being a profitable trader, you'd have to stick to one individual model for one individual model for one individual market for one asset class for one time frame, like days trading for your individual time you execute. When you choose to execute, there should be little to no ambiguity when you're executing, because if you do not have a rigid set of rules that you are currently following, you can you can easily go on a tilt. To prevent yourself from going on that tilt, you must have a well written out model. Yes, this is what I was saying earlier. You should have a journal that has an in-depth detail of your model first. You can be a little journal. It doesn't need to be a thick hard cover of a journal. Then the next step is for you to compress your compress your whole trading model into a very little piece of paper, like a business card. Your model should be able to be as simple as possible. You should be able to explain your model to, let's say you meet a, let's say you're trying to explain what to do in the marketplace to someone that is maybe in this industry. Let's put it that way, because you have no business explaining what to do to someone outside of this industry. And if you are to explain yourself to someone inside of this industry, you're not explaining yourself to seek validation. You're just trying to probably show the person your own unique perspective of the market, because every individual have different unique perspective of the marketplace. It's just we're just using the same language but speaking different dialects. Let's put it that way. So back to this, yeah. This is why I prefer an hindsight review of price, because it's easier to not go on a tilt, not go on a rant while trying to explain an idea, explain a concept, something as intricate as algorithmic theory of price. So you see, now, because narrative states that if we get to this fair value, here is fair value. If you've been watching this channel, you understand we are obsessed with the idea of value, of fair value. There's fair value is not just an idea of the fair value gap, because that is the normal and the first medium in which most of the community learns about the idea of fair value through the introduction of the fair value gaps. But there's more to fair value. Price seeks fair value every single time. Every time price balances and imbalances, it does that to seek fair value. Every time price goes below an old low, it does that to seek fair value every single time. So, but that's by the way. So we're expecting to see if these lows are taken out, because from the US 100, the US 100 has a clear price action for you to get where your negation point and your where you do not want it to be negated. Why and how is this an intimidating low? You see, it balanced this imbalance here. And also, if you look at this long wick candle, we indicated that when you have a long wick candle like this, the algorithm sees this as an imbalance, and the midpoint of that long candle is consequent encroachment, which is fair value. So you get precision when you have a general knowledge of most price action concepts, most of this language. So it gives you an ability to be as precise as possible in your dealings with this algorithm. So now, because this is an intermediate term low, if an intermediate term low is violated, this is the algorithm tipping its hand through the idea of market structure that we are going for lower prices, because an intermediate term price point should not be violated if it is in line with market structure, and if it is not in line with market structure, it will be violated. That is the algorithm telling you that you are not currently in line with the market structure. Say you are taking this long here, from this other block here to this high here, it's one single model. But like I said earlier, when you have a high impact news like FOMC the day after the current trading day that you are currently trading, you have price action like this. There will be an obscurity on precision. It's like an attack on precision. During these times, the algorithm leaves things to make ambiguity of precision, which haunts traders that seek perfection down to the point that we trade inside of the gray areas, and we seek the pinpoint entries as to where price will likely make a low before reversing, or make a high before reversing. Because you can, for example, this imbalance here now, you can label this imbalance like this fair value gap like this, and then you only indicate the high and low of this imbalance. But when you're a junkie for precision, you are obsessed with the idea of having a precise entry. You will now want to start considering other PDRAs like this long wick candle on your own. Look for the equilibrium of this candle and just take your quadrant, look for the first, second, and third quadrants of this candle here. A bonus point to study: when price is expected to go lower, the best shot will form at or below the equilibrium of a quadrant of a PDRA. So that's it. So you're still watching this price action to see how it is being delivered here, because we're chopping back and forth, failing to take out these highs when the US500 has already taken out its high there. We're not interested in buying anything above fair value here. If we are to enter trade, price should have come for this our imbalance here, and then we'll move higher. We are not entering in an impulsive manner or away from the laid out model for this current account. Let's put it that way. So we're only trading one account for one model, sorry, with one model, one time frame, and everything like that. So we can have a measurable set of data. So you see, we have price. This is price seeking buy side liquidity. Engineers buy side here took out that buy side. Engineered buy side here took out that buy side. This will be frustrating the uninformed. This push up in price, as it pushes up here, they'll see some uninformed money will see this as a resistance, so they will sell. They will go click to sell and place their stop loss here, and price will take them out and then start coming low again. they will now sell and place their stop loss here again, and price will take them out. This is price frustrating sellers. After it does frustrate sellers, it will then frustrate buyers. There is how it works. So I'll be ending this recording here. I hope you got something from this market review, from this live market review, and I'll talk to you in the next video. And if we are to come for this lows, yeah, during the 10:50 to the 11 a.m., during the 10:50 to the 11:10 a.m., which is you have this. So there's a macro, there's a 20 minutes macro from the 10:50 to the 11:10 a.m. So if we are to come for this lows here and violate this intermediate point in price and also this long-term low, would have to do that inside of this macro here. But let's see how price goes if we are interested, if we have to take out buy side liquidity now. If we take out buy side liquidity, yeah, this means there will be no trade until after FOMC tomorrow. So probably tomorrow's tomorrow's daily review will be for the afternoon session, which is after FOMC, and not the morning session. We will not participate in the morning trading for tomorrow, Wednesday's trade. Alright. Hope you got something from this video, and goodbye and good luck.